The basic strategy behind dividend investing is to buy certain companies that offer dividends, hold on to them for long term, and keep collecting on the dividend. And this is something that works really well in a bull market where everything just seems to be going up. But with everything that's happening right now, you see a lot of companies that are slashing their dividends or suspending their dividends entirely. So in this video, I'm going to share with you how you can navigate through these times as a dividend investor. So not only do you end better off when this is all over, but you are also preparing for different scenarios that can happen. So if you're a dividend investor who has a lot of dividend stocks already, there's really two different options you can use to approach your existing positions. The first thing you could do is sell some of your dividend stocks, keep the cash, and then you could have the losses to counteract some of your gains that you make later on. So this could make your taxes less expensive if you were to sell at a loss. And after 30 days, you could re-enter the position and hopefully it's down even more or it's not too much further up. The idea with this strategy is that you get a better tax write-off. The second option you have is DCA, which is dollar cost average. So if you bought the stock at $60 and you now see that it's down to $40, so you've lost 33%, one thing you could do is buy the same number of shares at $40 so that your cost average per share is $50. So it's a way of essentially buying on the dip and making your total loss in the entire position not look as bad, because you may have bought some shares at a really high price, but being able to buy shares on the way down gives you a better cost average for all the shares you buy, which makes the loss not look as bad. So with that in mind, you don't want to throw all of your money you have at investments at once, because if you put all of your money in at a high point and it goes down, you don't have extra money you can invest into that company to cushion the blow from a DCA standpoint. With that said, you don't want to do DCA just for the sake of having a lower cost per share. Only do this for the companies that you truly believe in, that they have an attractive payout ratio, they have a good history of raising their dividends, they're not a company that's at risk of going out of business because of what's going on. So it's just as important to make sure you continue to invest in the right companies instead of investing in a stock that has just plummeted because of what's going on and there's no sign of a bottom and you're just doing it to feel a little better about your DCA. So there is a difference between having a lower cost per share, doing that just to feel good, versus being strategic and doing it with companies that have the very strong potential of recovering after this is over. And while you do see a lot of companies slashing their dividends, suspending dividends, or just reporting overall like slowness and deceleration, one of the things that's still happening is growth, because the circulation of money hasn't entirely gone away. There's a lot of options that we don't have anymore, but there are some essentials like food, tech, healthcare. All these different segments of the economy are still running very smoothly. So with that in mind, if you look for the sectors and the parts of the economy that are still performing, that is going to be an indicator of where you should put your money. So for instance, there's Amazon that's just continuing to grow, because if you look at the whole business model between Twitch, I know this doesn't have a dividend, but in the like Twitch, AWS, Whole Foods, like Amazon's really primed for this type of atmosphere. That's just the way that the company is built. So you do have companies that are still thriving and even growing because of what's going on. Now, one of the things to note also here is Zoom. Again, a company that doesn't have a dividend but is growing. Where did this lead? Companies like Amazon and Zoom are customers for other companies. And for some of those relationships, like it's not just Amazon that's growing, it's companies Amazon pays that are growing. So that's one way you can look at it. So one of these sectors that is doing really well is REITs that are data centers, because those data centers, how do you think like Zoom is still operational? How do you think all these websites flow and stay steady? It's data centers. And those are the types of REITs that they have outperformed other REITs, while you see other REITs that are really struggling right now. Like there are some of these REITs like DLR and other ones that have already fully recovered and gotten to the point where they were before the virus. Now that can change obviously within a few weeks because oil is negative at this point, but they have recovered and grown at a faster pace than a lot of the other sectors affected by this. So you can still find buying opportunities. Just look for where people are spending their money and what they're spending it on. So you see, again, a lot of food. You see a lot of people like working from home now. So a company like Zoom, WebEx, by the way, is owned by Cisco. So that could be a compelling play as well. So you do want to look to see what's still working and focus on those investments. You also have the angle where a company that's just been destroyed by what's going on in terms of their stock price can, in a few years, fully recover. And then you have the scenario of buying a company at a really low price that a few years later soars to a like pre-corona price, but it pretty much soars to a really high price relative to where it is now. That is also an opportunity. But the only thing with those companies is you want to make sure that you are buying them at a time where the narrative's getting a little better. So out of like all the different types of business segments, like fitness and gyms, like those are going to recover relatively quickly because you have a lot of people who want to have this be uplifted. Like you want to have a lot of people like reopen the economy. You also have a lot of people who, when it reopens, they're just going to want to do social tightening. So either way, you do have a bunch of people who are like eagerly waiting for everything to go back to normal. And something like a gym that's very affordable, those are going to grow at a faster pace and return back to normal sooner than something like the travel industry, where you've got corporations paying for people to travel to different places. Well, those payments aren't happening as much anymore because the corporations have to recover first. And then some people are going to be afraid of going on airplanes, but you have other people who are going to be super excited to travel, and they may just want to get out, which is a big theme. People want to get out, and that's going to be something that factors how quickly certain segments recover, and also people's budgets, because like a gym membership isn't that expensive, while travel is something that is too expensive for a lot of people, especially with different things that are happening. So it's not just a matter of looking at which companies can do the best. It's a matter of trying to think like, what will happen when this is all over? Like, are people going to want to spend excessively and do all these different things? Like, I think people are going to be more money protective, especially when it comes to mortgage and rent payments and all the stress associated with that. Because, if you're someone who hasn't been affected by this, I mean, things may be going normal for you, but there are a lot of people who have been very affected by this, and people who were previously maybe spending on a hotel room aren't doing that expense, not just because of what's going on, but they may have to hold back later on also, even when everything's back to normal, just because of just adapting to the financial situations that they're in this moment in time. So even though there are a lot of companies that the dividend scene doesn't look very good, you still see some companies that are continuing to raise their dividend because they are seeing heightened demand during this time, or their demand is remaining relatively unchanged. And by having an idea of where this is going to go, like knowing that, like data centers are still going to be performing very well, and when the economy reopens, like what are going to be some of the things people swarm to first? Like there's going to be a big boost in restaurants, in my opinion. not just the local ones, but obviously the big chains that you can trade and exchange on the stock market. So thinking about things like that really gives you a better perspective of which stocks to invest in when it's all over and everything's back to normal. It also gives you a better idea of what to invest in right now. But with dividend investing, there is this long-term focus, and part of a long-term focus is sometimes just holding on to your cash. You don't need to invest right now if it doesn't make sense. Like, don't invest just for the sake of investing. Like, if you want to invest just to get your feet wet, because I do feel like when you invest any amount of money, you suddenly become a better investor because you have more practice and experiences. Even if you do like a fractional share, $1 of like an index fund, that's the easiest way to get started. $1 is very low risk. And this is for people who just haven't invested at all. Like, I think you should, even if it's just $1, just because you pay attention a lot more versus if you have nothing in. So holding on to a lot of cash, though, is a great way to boost your dividend. Now, cash, I mean, cash in the bank, that's not the dividend income anyone brags about, but it's holding on to the cash, waiting for a stock to go down even more based on news that's happening, based on what you think, and then being able to buy more shares at a lower price. Again, don't go all in with your cash at once, because you have the whole DCA, where if things go down even worse, you could buy at that even worse level to kind of balance things out on your end. So it is important to just keep paying attention to what's going on and think about what your goals are as a dividend investor. If you guys enjoyed this video, make sure you subscribe, smash that like button. I'll see you guys in the next one. Until then, dream big, achieve greatness, and unlock your potential today.